Hey traders, it's Jeff Tompkins, Chief Investment Strategist at Altos Trading. Today, I'm sharing one of my powerful institutional level strategies for selling volatility credit spreads. I'll walk you through the strategy, and by the end, I'm certain you won't look at option credit spreads the same way again. Let's get to it.
Okay, so let's talk about a volatility play because obviously we're getting a spike in volatility, so we're in vol expansion right now. Uh, and of course, this helps us navigate, where we go moving forward, because in order for us to reverse and continue back to the upside, volatility has to come down significantly um, and stay there, right, for a while. So with the VIX, it's critical to know where your resistance levels are when you're getting a vol spike. And I don't just look at these by themselves. I look at these in correlation to support levels on the S&P, right? So if VIX is spiking up into a resistance while S&Ps are simultaneously rotating down into support and those are holding and the VIX starts to come down off resistance and the S&P starts to rise off support, beautiful, right? That's a long opportunity. But if we just want to trade volatility, uh, there's so stepping back a little bit, anytime the VIX is down at low levels, right? Especially if I get a trade trend buy signal, I'm initiating long vol positions. So I'm typically putting on vertical call debit spreads in the VIX, and I've got one on right now that's making money because I put it on way back here, and sure enough, the VIX is rising. We're going into vol expansion and making money on a vertical call spread. So that's playing the VIX to the upside. But some people aren't prepared for that. Sometimes the VIX spikes, it catches you off guard. Well, that creates amazing opportunity if you know how to navigate it and trade it. And so, again, we've talked about this in prior sessions, but what it looks like is, again, knowing where your vol resistance levels are. So I'm just kind of more art than science. I'm just kind of eyeballing this and looking for significant past VIX spikes and I just from experience tend to kind of know where these are, like what price levels they coincide with. Um, okay, so very unusual for a VIX to spike to 30, right? But it does once in a while. Anything above that, I consider to be very high. Um, but ultimately, there aren't a lot of inevitabilities in the market, right? There aren't a lot of certainties, but there are a few. And one of those is that volatility always alternates between contraction and expansion. So volatility is either contracting or expanding, and right now we're in expansion mode. And so we know with pretty much, always hate to say absolute certainty with anything in life, but we pretty much know with absolute certainty that vol is going to come back down. It's just a matter of when. So one of my favorite trades is to, uh, I like playing volatility to the long side, but waiting for volatility to spike into resistance and then looking for confirmation that it's coming back down. Okay. There would be on that day off of a level or near the level. So this 30 level you could have had mapped out from the vol spike back in February. And so it's important to always keep these on your charts because then even though it's many months later, September, October rolls around and we get a vol spike up into that level. Or November, the November vol spike. And actually, I traded this one with the strategy I'm going to show you. We get the vol spike, right, into a level that I could have already previously had mapped out. We're essentially, I would consider this a test of this resistance. Okay, this is a much more common, right, VIX level to spike up into. It's going to be kind of up around 2150 to 22. Okay. And so we didn't quite make it there, but I would consider that. Okay. So we're at a bit of a volatility inflection point where we either come back down significantly or we spike way back up and start breaking resistance levels and we get more vol expansion. All right. So let me just clear all that out so it's not too messy. Okay. So a couple things to watch to kind of navigate that. is range contraction and expansion. So looking at the daily time frame and the high-low range of the daily candle. So notice how when we had this, it's like, okay, so we had a VIX spike here, right, in earlier in January. See the range contraction or expansion, sorry. So the daily high-low range is widening relative to the prior high-low ranges. Then when it pulls back, see how it narrows? Okay. And then we spike and see how it's widening. Okay. So on the spike, okay, you're going to, as it starts to lose steam to the upside, okay, you're going to see a much wider candle. So like back here. And then you're going to see a very dramatic range contraction. So like here or here. Okay, that's often a good indicator, but again, don't use that as a standalone. Apply it to levels. So this was a very, very tradable opportunity, a great opportunity to do the trade I'll show you because it was right into resistance. Okay, and then we get the range contraction. Okay, and then the VIX comes back down. Now, that's those are a couple of things to look at. The other is where did the spike initially price level wise, where did it start? Well, this one's a little trickier. I would say probably right around the 1550 level. Uh, you might make the argument it was back here, but that was like a 52-week VIX low, and there was a significant spike there that pulled back. Okay, so you can see prior resistance here, and then support, turn support, and then the retest. So I would consider that kind of roughly the level where the spike started, right? Because this was a pullback, and here's the spike, the next spike. Okay, so what you want to do is reference where the spike started. So that was, let's see, today's Tuesday, markets closed yesterday. So this would have been what, Thursday's candle? Okay, so it started Thursday last week. Now, we don't know how much higher the VIX is going to go. So I mentioned some of the things we need to look for. The key is you want to reference the amount of time it takes for that VIX spike to play out. So like if we look at some of these past ones, here was the VIX base right around 17. Okay, that's where it pulled back into before it spiked. And then it took what, about 1, 2, 3, 4, 5, 6 sessions or so. So about a week for this spike before it came back down. Looks like that was a similar case back here in October. Okay, so that's step one. You want to reference how long it took for that spike to occur. Okay, like this one took a bit longer. This one took several weeks. And here's why. Look at how long that spike takes to play out. It's roughly equivalent on the way back down. So look at this one. This one took a little bit longer to come back down. And that's kind of my rule of thumb, right? The greater the magnitude of the spike, right? Obviously, the longer it'll take to come down. So you want to take that into consideration. But in general, right, it looks like a pretty symmetrical triangle. Okay, so wherever this one ends up, okay, like let's just say hypothetically, we spike up in a 25, and that happens by Friday. So we've got about a week of duration for this spike to play out. Why is that important? Because that's going to dictate the expiration cycle that I select. Okay, because I want to know, and I by the way, I typically add a multiplier to this. So let's just say it takes a week and there's my VIX position out at Feb 18. It usually takes about a week, or if it takes about a week, then I usually add a little buffer to that. So maybe a 1.5 to 2 times multiplier. So on a short duration spike, like a week, let's say, for hypothetical purposes, I'll probably go 2 weeks out in expiration. So let's just say the spike has already occurred and I want to uh, put on a short vol play. I'm going to go out to Feb 4 because I'm just assuming, again, this is all hypothetical because this hasn't all transpired yet, but assuming the vol spike lasts about a week. Okay, so I'm going to go 2 weeks out in expiration just to give myself a little buffer. So I know with a high degree of certainty, assuming I was correct about the vol spike being over, that vol will come back down. And it will always come back down below 20 at some point, right? We know with certainty that the VIX is going to come back below 20 at some point. So this is where I look at selling an in the money call credit spread, right? If you've done credit spreads, you're probably accustomed to selling out of the money premium, right? Selling out of the money credit spreads. Here is where I look at selling an in the money credit spread. And you can get incredibly favorable risk reward ratios on these. Now, this will be a little hard to demo because we're after market hours and the bid ask spreads are all wonky. They're extremely wide. So this happens on the VIX. So it's going to be kind of difficult to demo this, but um, you know what I'm looking at doing. So going back to where did the VIX base before it spiked in the most current spike, right? Well, I've identified that around 1550. Okay, so I'm going to use that as my long strike. Okay, so my short strike, I want to be below 20. So maybe I do like a 1915. Let's see. Oops, I got that backwards. Sorry. I'm selling the. Let's see. Get that. Okay. Sorry, I said that backwards because I had, for some reason, vertical call debit spread in my head. Okay. So, like, I could do a 5 point wide. Okay. And again, this pricing is not going to be accurate because of the wide bid-ask spread, aftermarket bid-ask spreads. Uh, but what's cool about these, and especially when you get more significant VIX spikes, and we did one of these in our live trade room on the most recent VIX spike prior to this one, where we sold, I think it was a 5 point wide in the money call credit spread, and I think we collected like 383.90 credit on a 5 point wide. So my profit potential is the credit, right? That's my max profit potential. I just need the VIX to come back down into my short strike. Um, and my max loss is the width of the spread minus the credit. So you can see when you're selling out of the money credit spreads, right? You have an inverted or inverse unfavorable risk reward skew. Okay, with the in the money call credit spread on the VIX, you have a very favorable risk. So even if the VIX continues to spike, right, your loss is buffered because it's also a defined risk trade, right? Your risk is capped at that width of that spread minus the credit. Okay, and so often I'll leg into these if I have some uncertainty about whether the VIX is actually coming back down. I might allocate half of my intended allotment. So if I'm intend to do a full 10 lot spread, I might put on 5 contracts, and then if it does continue to spike, I'll add 5 contracts, same at the same strike prices, but for additional credit at a higher VIX level. Okay, because I know with certainty the VIX is going to come back down, so it's just a matter of time. And so this is the in the money VIX call credit spread strategy, and it's the way that I play volatility. One of the ways I play volatility back to the downside. I have other strategies like calendars on the vol futures, on the VIX futures, and other things that I do. And sometimes I mean, much riskier, more margin, higher level of options trading approval. Sometimes I'll just sell a naked in the money call on the VIX, but the safe way to do it is just a vertical call credit spread, and then structuring it in the fashion that I just demonstrated.